Hello everyone, welcome to part 3 of my course How to Invest to Stock Through Options. By the way, I didn't make a video of part 2 of our course just because part 2 is about diversification and how we apply diversification rules for our strategies. It's nothing to show there, so I made a pretty good PDF file which you can access in our Discord channel. This one is much more important and probably more interesting for you. It's part 3. We will talk about how we're actually setting up our positions and how we adjust them if it's necessary. Uh, let's start with something very good candidate for our strategy like TLT right now. If we check chart of TLT, we can see that right now it's in good range, somewhere between 85 to probably 100 if we check in long term. And why it's good candidate? Because it's policy of we don't know and nobody knows right now what happened with our economy. We will go to recession or not, where is gonna be interest rate in near future. So it make TLT pretty good candidate because volatility is much higher than usual, and we can make good money from this because our strategy is to sell options, and more volatility we have, easier for us to make money here. So in normal market and economic condition, maybe TLT is not the best candidate because volatility is low, but if how I discuss it in part 2, in normal situation when volatility is low, we usually go and play interest rate in real estate investment trusts because they are also related to long-term interest rate, and usually they have higher volatility than the TLT. But right now it's a perfect candidate, how I said, and we will continue to play it during this year. So let's see how I do that. I prefer to open. You can see right now in my position, I have a structure at 110 days till expiration and 47 days till expiration. So the best way to play our strategy to make multiple layers of different expirations. It's I like to do at least two, but sometimes it's more than that, 3 or 4. More layers you have, more stable your position, and you need much less adjustments in this case, and at the end you will make more money. Let's see how we're gonna play that. For example, right now, if we go long term, I always would like to set up a structure that will cover better downside of the market. It will be as a base for us, and make much more profit from downside than upside. But shorter term, we will do it a little bit more aggressive upside. Let's see how it's gonna work. So I usually use straddle or ratio straddle. Let's see how ratio straddle look like. So for ratio straddle, we sell 2 puts against 1 call, and in this case we do it a little bit lower than where's the TLT right now. So it's trading at about 90. We set it up at 88. let's see how that structure look like. This is how that structure look like, and you see that this structure is covering interval from 84 to 96. If we see on the chart, 84, it's much lower than our range, and again, upside is 96. 96, it's right here. So it's pretty good range. This is how we set it up, and we hope that during that period of time, TLT will trade somewhere between that range. But if it will go outside that range, it's not a problem. We will probably, as a layer of our position, will make money in this situation, and we can adjust this layer too. So again, let's talk about Greeks of that position. First of all, our buying power is pretty low. It's just $300. And how much we expect to make here? We definitely not expecting to make the maximum available profit, but at least we plan to make about $400 from this layer, which is more than 100% of our buying power. And if you use it, let's say 30% of your total margin, so it's still pretty good. It's more than 30% of your account just for a little bit more than 3 months. This is long-term structure. If we would like to set up shorter term at the same time, we will go probably to 47 days till expiration, and it's exactly how we set it up right now. In our case, I did ratio 1 call for 3 puts, but you can do 2 puts. It's not a problem. Let's do it 2 for now, just to see how it's look like. Can you see if our longer term is more covering interval below the today's TLT price? The shorter term is trying to get some maximum profit upside. So right now it's covering interval from 88 to 97. Let's see where it is. 88, it's still pretty low, and 97, it's quite high. So this is our short-term interval, and we will plan to hold it and try to make money from this. If necessary, it will be adjusted. Let's see how Greeks here is look like. So delta is positive offshore. Of course, it's about 5. Buying power a little bit higher because it's shorter term. It's about $800 total margin. And how much we're gonna get from here? Probably also $400. So $400, it's approximately 50% of margin. So account size, it's probably about 15%, but it's only for 1.5 months. So this is how we're gonna set it up, and in this case TLT. Let's see something, another stocks. I like SLB. Why? I'll show you. If we see chart, it's pretty low. It's trading about 40, and you see how even it's going down, it's still trading in good range, and because it's just $40 stocks, we can afford to open lots of different layers for that and enjoy to get profit from it. So right now you can see that SLB just touch 200 moving average and start going down. We don't know it will continue to go down or stay there, but it doesn't matter for us. So we're expecting probably short term will probably can go up to 40, something like that, but we don't expect it to go much below 37 level. So let's see how we can play that with our strategy. By the way, this is my existing position. Right now we have 1, 2, 3 layers of position, and it's covering from 35 and a half to 47. If we go 35 and a half, it's lower than the all-time low, and 47 it's pretty high, and I'm pretty comfortable with that position. But let's open the new one. Let's imagine that we don't have anything right now. So let's go to long term. In this case, probably 138 days till expiration. It's a good candidate. And remember that we open it below the market long term usually. So we'll do it 1 to 2 as usual. You can do 1 to 3 because it's a pretty cheap stock, so you can increase that ratio. And you see buying power only $150, which is very little. And if we go to curve, this is how it's look like. Can you see it has a negative delta because we open it below the where the stock trading right now, and this is exactly how we would like to set it up to control this area. If SLB continue to go down, we will roll our shorter term but slower make profit from long-term structure. So right now it's covering interval from 33 to 46. 33, it's not even on the chart. 46, it's well above the range where it traded during last year, so it's good coverage, I think. If we do it, in this case, 1 to 3 ratio, 1 to 3, it will be even better. I think it will cover from 34.5 up to 47, 47, 44.5, and still below the available prices right now on the chart. So this is how I like to set up long-term base position structure or layer, whatever you would like to name it. And if we go to shorter term, probably we're going to choose 47 days till expiration. And how you can see if long term is covering our lower interval of the stock, this one we can set up a little bit higher. Again, one short call and 2 short puts, and let's see how this structure gonna look like. Go to curve. Yeah, buying power a little bit higher again because it's shorter term and our naked puts in the money right now. This is why it's $800. So how much we're gonna get from that? I'm expecting, if everything fine, we're gonna get about $300 from this, and it's 30%. 30%. It's mean that if we just use third of our buying power, so it's about 10%, but it's in 1.5 months, which is not bad. And what interval it's covering? It's let's say from 40 to 48, uh, from 40 from 40 to 48. So it's because it's a positive delta. Yes, it's lower term is much higher, but still in good range. If market decline and go below that, we will take care about that and probably roll it or roll it out or do something, or maybe just add another layer which will cover lower interval of SLB stock. So this is how I play it. This is how I set it up. You can do it for any kind of stocks the same way, and enjoy and don't do much. Remember, I cover it in part two. We are in investment, not in trading. So if our position is go down and some of our options get in the money. By the way, some of them we set it up in the money right from the beginning. We don't worry about that because we play in range and it's not a, we don't play probability of touch, we're playing probability of expiration, so we're expecting that probability very high if stock went out of the range, probably it will return back sooner or later. And we will try not to adjust it or touch it until that options still have pretty good extrinsic value. Remember, in this strategy we don't play delta, so we not trying to make money from market movement, but more we get our profit from time value or extrinsic value of options which we sell. This is why it's crucial here to choose right candidates, which like SLB, we see it's trading in the range. It could be changed for sure, and that's why diversification is also important. It could be changed and start trading up like crazy or going down, and probably we're gonna lose from this position. But if we diversify our positions by different industries and asset classes, I don't think that we're gonna have this problem for more than 10 or 20% of our holdings, and we will take care about that. So now let's talk about adjustments. I would like to show you adjustments of positions which I already have, and it is good time to do that adjustment because on Friday, how you know, market went down again. It's probably the new leg down. We don't know where it's gonna go. It's gonna bounce up from the low. It's gonna bounce up on Monday, right where it is, or it can penetrate that low and go another leg down, full leg down. We don't know, but for sure some of our position after this big move of the market right now in red, mostly it is tech stocks. By the way, I mentioned it in part two, I don't recommend you to trade tech stocks in this strategy unless you're very comfortable with it. And even if volatility is extremely high, but very often for tech stocks, realized volatility sometimes very higher than implied volatility. So it's it can move and move more than actually market expected, and it's harder, much harder to make money from these stocks. Plus, it's usually expensive, and you have to use lots of your buying power. So I don't recommend you to trade for now any tech stocks, but because we have it, I would like to show you. The first, which need to be adjusted, it's Amazon. If you see, one of our layers have only 18 days till expiration, and the most important thing, our call and put already out of extrinsic value. So our call just cost 40 cents. We sold it originally for $3. Our put cost 22.5, but if you count, if you check it with Amazon close price, it's virtually nothing there from time value point of view. So let's see how it's look like. By the way, this is my total structure of Amazon, and yes, I'm expecting that sooner or later it start going up. So this is why our structure look like this. But let's see them layer by layer, because Tasty Trade unfortunately doesn't show correctly the structure if we use at the same time different expirations. So let's check them separately. So this is 18 days, that one which must be adjusted. You can see it's not just lost already all extrinsic value. When I said lost, it means we get it, it's our profit. But from this structure we lose from delta for sure. And you see that price right now, right at the edge of the structure. So it's time to, it's another reason to adjust it or roll it. So how we're gonna do that? It's a different way to do that adjustments. I'll show you probably all of them. The first and the most important one, we will probably roll it out. Can you see it's how far it is right now? So we close it and go to probably somewhere 47 days till expiration, May 16, and probably we will choose strike lower than it was before. So it was before 215. We can choose right now 205 and do it like this. So can you see that virtually we don't have any debit? It's only 38 cents debit for that roll, and our buying power increased because we reduce risk, and this position itself as a roll has good negative delta, which help us because right now our structure much more positive than it was when we open it. And let's see how it look like. So this is how it looked like now. You can see that if we were right on the edge of the structure, right now we kind of reduce that profitability point from 192 to 182, 10 times lower. And right now, just this structure covering from 182 to 225. So it's 182 to 125. This is how it's covering it. Also, before I do any kind of adjustment, guys, I would like to see all my separate other layers to see how they are set it up. So let's check it now. So right now we have 110 days till expiration, just a regular straddle at strike 200, and we have a structure, base structure at 173 days till expiration. Let's check how they look like. how 110 look like. It's in perfect shape. It's right. Virtually, it's right on top right now. Amazon trading at the top of the structure, and it's covering pretty good range. We oh, sorry. Let's clear it because it shows our adjustment. So this is where we are right now, and it's covering 165 to 235. 165, 235. It's covering virtually all interval from lowest low for this year, which was around 160, to virtually highest high. So it's that structure in perfect condition. It's neutral right now, but again, because Amazon declined so much, we should be playing a little bit upside. This is how we're gonna set up our role. And if we check our another structure, which is base and long term, this is how it look like. By the way, you can see that it doesn't have much risk upside just because we cover it with long call. I usually don't do that, guys, but I do it only for tech stocks because they're crazy and they can run up so fast and so high. I wouldn't like to be my short calls can be in trouble, especially long term. So this is why for this Amazon position, I decided to buy a call at strike 200. So right now, this is how it's look like. And it's safe as a serve as a huge range below the market. In case something happened with Amazon, unpredictable, and during this year, it will slowly continue to go down. At least that base is gonna serve as a soft hedge. So how I said, it's another one of the way to roll our 18 days till expiration position. Let me repeat, show it again. So we just close it at 18 days and probably open another one at 47 days till expiration. And because we're trying to play it a little bit higher, we can open as a regular straddle here, or if you want, we can go a little bit lower and let's say 290, but in this case open as a ratio hedge, and it's going to be two puts against one call. So you can see that this kind of setup will even reduce little bit our buying power, and we get huge 7.4 credit for that. And let's see how it's look like if we go here. So if we do it this way, lower a little bit our strikes for new position, but increase amount of short puts. Now structure look like this. It's covering for 47 days interval from 175 to 220, 175 to 220. So it's pretty good range we're covering, and it's gonna be probably good move. The third way how I do that, usually, uh, probably I'm not going to do it now because it is time to roll our existing 18 days till expiration position. But if it's still longer term and it's still extrinsic value, but market moved a lot, so we can, instead of rolling or moving that existing position, we just can add more layers. And I would like to show you on our position in Google, which is also a little bit down after big move. Let's see how, can you see on Friday it was huge move down, and we're approaching lowest low of the year, about 150. Right now it's trading at, it's closed at 154. After this big move, our position in loss. Why? Because we played here when it came down to 200 days moving average. We open it, it's go below that. After that, bounce up. We were in profit. It's go down again, bounce up. We was in profit, and it's go down again, and we are in red. So let's see how our total position look like right now. So right now it's trading at 155. You see we have pretty good big structure. If Google stop falling down and going up a little, it should be in our position in good profit. But it's still, because we expecting that it will go higher, but we have to be protective and probably do something with downside risk. First of all, let's see our layers separately, how we do it usually. We have 82 days till expiration, and we have 173 base, the same base how we set it up for Amazon. So short term, you can see we approaching the profitability tent, and probably it's time to do something. Even we still have lots of extrinsic value because it's 80 plus days till expiration, and this is why it's a good adjustment. Just instead of moving that strikes which we already have, maybe it's good time to add new layers, but we will see. So this structure, how we see that it's covering from 150 to 105 interval. So 150 to 105, it's very good interval, but this is why I wouldn't like to touch it, because I'm pretty sure in 80 days we're gonna be somewhere in this interval for sure. So it's no good reason to move it. And if we check our base, which is 173 days till expiration, and it's look like this. You see that we don't have risk from upside because we have long call here. Same reason how we did it for Amazon, and it's covering huge interval up to 135. It's right here, and I don't expect that we will go there pretty much soon. So, but we still have to have it as a protection, especially if it's no risk upside. So how I will do it now? Probably if we, because we would like to cover a little bit downside risk, we can go and add something to our 83 DTE structure. Let's try to see what we can add here. This is how it's looked like right now. It's 170 strike. We're right now at 150 5 approximately, we can go and sell at the money here 150, just a regular straddle, and let's see how it's gonna look like. By the way, we don't have choice but increasing a little bit our margin because we virtually increasing risk downside a little bit, even if we make our position much more safe, which I believe if we don't expect that Google go to zero, it for sure. So this is how it starts looking. If you remember, our lower point was approximately 155. Now we move it at least 10 point down. So now it's covering from 145 to 190, 145 to 190. We lower down a little bit our interval from 200 to 185 just to protect a little bit it's from downside. And this addition is yes, it's reduced a little bit positive delta, about -6. Actually, no, it's -20. -6, it's a better weighted for SPY, which we shouldn't take care about this right now for stocks. Yes, so we got more than $20 in credit for that. Probably this is how I'm gonna play this in our case. Let's see another interesting position which we have trouble from upside. It's CVX. If you see if you see right now our position in CVX, we actually did some adjustment a couple of days ago and increased that 10th upside, but this is where the CVX trading right now, about 166. If we check a chart, you can see that crazy move up. We went way above previous high range, and we actually expecting that it will go down a little, and it should go down, but who knows, maybe not, maybe it's start uptrending and can go to 70, 170 or even higher. So we have to do something with that. If we check again how it's look like, first of all, now it's covering our interval from 145 to 172, which is 172, 145. You can see that we kind of in good interval, and if how we expected CVX start trending down and go back to range, it's gonna be in huge profit sooner or later. But if not, we probably need to add something to that position to protect a little bit us and increase that profitability interval a little bit higher. Right now we're at 172. Maybe we need to add something to increase that interval at least to 175. And but first, let's see how our separate players doing. So one of them, it's 47 DTE. By the way, it was 18 DTE just a couple of days ago, and we did that move to 47. Right now, 47 DTE look like this, which is covering from 152 to 173, I believe, which is in good interval, and I'm very comfortable with that. But another one, it's a little bit in trouble longer term. Can you see it's just a regular straddle at 150 strike, and we're approaching top of this top of structure, and we actually have loss from this structure more than from other. Uh, yes, you can add something to that, like maybe one extra short put. Shouldn't be probably at 150 strike, because let's see how much it costs. 150 put, it's just at $3.37. Doesn't make much different, and will get a lot of pressure if CVX start going back to original range. So I don't think it's a good move. But we can add something shorter term. If we go here, we can, for example, add something to 82 TTEs at the third layer, and it could be something like new position, new one short call with two short puts at strike 165. Yes, we will increase our buying power for $1,000. I hope you have reserve for this kind of situations. Let's see how it's look like. Well, it's our long term. If we add it to short term, let's add all them together. So if we add this, so we will expand our profitability trend to about 175. This is our plan, and our lower will still be about 150. 150. It's somewhere at the lower level of that range. Probably it's gonna be appropriate adjustment now, just addition. But if you wouldn't like to add more margin to that position, you can do it probably a little bit different. Instead of, let's say, open one short, one call and two puts, we can open 1-to-1, but this case we're gonna move that structure a little bit higher. Let's try to do it. Let's say that we'll move it to 170. In this case, we will get additional 15 positive delta. Still buying power, we have to increase it by 1,000, unfortunately, because it's pretty expensive stock. So, but in this case, we're gonna have a structure like this. So it's gonna still cover 100 up to 175, but because we have only one short put, our lower interval will be a little bit lower than other adjustment. It will be around 147.5, which is a little bit better. Or the third way, if you wouldn't like to add any margin, additional margin, we don't have much choice but do some roll of our 182. So what we can do here, I don't know, to make it a little bit more positive delta, we can probably move our short call to 170. This way we will also increase delta by 27. But in this case, we have to do it with debit, about 6. But we reduce our buying power by $355. Let's see how this adjustment gonna look like altogether. it's not as good as its previous one because previous one covered our interval up to 175. This one about 172.5, but it's still doable. You can do it this way. Later, if market continue to go, if CVX continue to go higher, we can roll our naked puts also higher and make that structure a little bit extended to the upside. So this is how I do that, guys. So it's more than one way. I recommend that for you if you see that your structure is need to be adjusted. First of all, it's not trading again, it's an investing strategy, so we don't need to adjust it pretty often unless it's huge move and our one of our layers stock price at the edge of our layer structure. In this case we can do adjustment. So my how I do that. First of all, I check other layers, how they look like and where actually the structure is. And after that, I deciding how I gonna adjust that one which in trouble. So again, it's 2 or 3 different ways to do it. You can roll that naked puts, you can roll them out, or you can just add more layers. This is how I play this strategy. I hope, guys, you will like it, and I'm pretty sure if you get comfortable with this strategy, you stop doing anything but this. It's a very good strategy, and it's cash machine. If you choose right stocks, especially not expensive one, and put 4 or 5 different layers for each of them, you can make it very smooth and money making machine. You can join our Discord channel for new guys. Just would like to say that I make 80% discount for first month, but it's gonna be only for 5 persons per month. So March already, I believe it's no spots available, but it's March 30th today. April gonna start in a couple of days, and you can join us for 80% discount for first month. After that, it's gonna be €100 per month, and you can see in our Discord channel in real time all my new positions, opening and adjustments. I hope you like it, and as soon as you get experience, you can do it yourself and you will enjoy it, because it's low stress and very profitable strategy. What I expect from that strategy, it's lots of question about that. Well, I expecting from positions, portfolio of this kind of positions, at least 20% profitability of portfolio, probably much higher, and I expecting that probably 50% of our holdings will be very good profit, and another 50 after adjustments it will be probably around zero with small loss or small win. This is what I expecting, but usually 50% of our holdings should be in very good profit. Some of them will be more than 100% per year for sure. And thank you very much, guys, and I hope that you like that. By the way, I don't know about sounds because my mic is down, unfortunately, and I have to use just regular mic from my laptop. Hope you can hear me well. Thank you very much, and see you in our Discord channel. Bye bye.